Many people struggle with financial insecurity, living paycheck to paycheck and fearing they'll never achieve wealth. The stock market intimidates beginners, causing missed opportunities and ongoing stress about the future. This is a summary of the book, A Beginner's Guide to the Stock Market by Matthew Crater, offers simple solutions, teaching proven strategies like ETF investing, dividend stocks, and picking winners like Warren Buffett. Avoid common pitfalls and start building passive income today. Unlock the world's greatest opportunity machine for lasting financial freedom. Let's find out more.
It's great to be here. And honestly, that intro, it hits on something so real. That word intimidation. I think for most people, the stock market isn't this, exciting field of opportunity. It's a source of pure anxiety.
Oh, 100%. It's just flashing red and green lights, people yelling on TV.
Yeah, exactly. People in suits yelling, and these complicated charts that look like they're designed specifically to confuse you, to keep regular people out.
I mean, I consider myself a pretty smart person, but for years, just looking at a stock ticker felt like trying to read code from the Matrix or something. You see the numbers, the arrows, the jargon, short selling, PE ratios, market cap, and your brain just wants to shut down.
It does.
You just think, nope, this is not for me. This is for, the guys in $5,000 suits on Wall Street.
Right. And that's exactly why I was so drawn to this book by Matthew Crater. He really seems to be on this mission to dismantle that whole exclusive club vibe.
He does, doesn't he?
He really does. I mean, his background is fascinating because he was on the inside. He was a hedge fund manager. But the way he writes is the total opposite of what you'd expect from that world. He frames the whole thing not as a casino, not as a battlefield, but as an invitation.
An invitation. I like that.
Yeah. His whole point is that building wealth shouldn't be some kind of privilege. It's a mechanism. It's a tool. It's just sitting there waiting for anyone to learn how to turn it on. He calls it the world's greatest opportunity machine.
Which is such a great way to rebrand it, because machine implies it has, gears and levers. It has rules.
Exactly.
And if you just read the manual, you can operate it. It stops being this chaotic, angry beast that's just out to eat your savings.
Right.
But I do have to play devil's advocate for a second here. If it's such a great machine, why do you hear so many horror stories? I mean, we all have that friend or that uncle who lost their shirt in some crash. Why do people say the market is rigged?
And that is the absolute critical question. Crater gets right into this. He talks about the user interface, if you want to call it that. The machine itself works perfectly, but most people are using it completely wrong.
They're pushing the wrong buttons.
They're pushing all the wrong buttons. They treat it like a slot machine in Vegas instead of a wealth-building tool. They run in looking for a quick jackpot, they get super emotional, they buy high when everyone's excited, and they sell low when everyone's panicking.
The exact opposite of what you're supposed to do.
The exact opposite. So the mission for us today is really to move from that reactive state where you're, yelling at the TV because your favorite stock went down to a proactive state where you understand why it went down, and maybe, just maybe, you even see that drop as a good thing.
A drop being a good thing. Okay, that already sounds completely backward to me, but I'm intrigued. I know we're going to get there. Before we get into the how-to, I want to stick with the what. What exactly is this machine? Crater breaks down the people who use it into two camps, and I think a lot of people might not know where they fit.
Right. He draws this very clear line between the investor and the trader. And this isn't just, a matter of words. It's a totally different psychology. It's a different lifestyle.
Okay, so break it down for us. What's the difference?
So the investor's playing the long game. This is the get-rich-slowly crowd. Their whole goal is to buy a piece of a great business and just hold on for years, maybe even decades.
They want to sleep at night.
They want to sleep well at night, exactly. They are not checking their phone every 5 minutes to see if the stock moved by, 12 cents. They're looking for passive income, which we'll talk about. Dividends, and that slow, steady, long-term growth.
That sounds lovely and very, very stress-free. But then you've got the other side. The traders.
The traders, yeah, these are the hunters. They're actively looking for shorter-term price movements. This could be day trading, literally buying at 10 in the morning and selling at 2 in the afternoon, or maybe swing trading, holding for a few days or a few weeks.
That sounds exhausting.
It can be, but Crater makes a really good point that trading offers a different kind of psychological reward. It's a dopamine hit. It's the thrill of the chase, the excitement of being right. But it requires so much more attention, so much more discipline, and frankly, a way higher tolerance for risk and for being wrong.
So you really have to know which one you are.
You have to know who you are. He warns that if you're an investor, a long-term person, but you start trying to act like a trader, you're going to get burned. You'll panic and sell at the first sign of trouble. And if you're a trader trying to act like an investor, you'll just get bored and make a reckless move just to feel something.
Okay, so step 1, know thyself. But whether I'm checking my portfolio once a year or once an hour, the underlying machine, it works the same way. And this brings us to a concept in the book that, I'll be honest, it really broke my brain at first. He calls the stock market a forward-looking mechanism.
Yes, this is maybe the most important concept in the entire book.
He uses that Wayne Gretzky quote to explain it, right?
I skate to where the puck is going to be, not to where it has been.
Right, which is great advice for hockey. But how does a stock market skate? I mean, it doesn't have a brain.
Well, actually, in a way, it has millions of brains, all working at once. Think of the market as this complex emergent system. It's like the weather or an ant colony. It's made up of millions and millions of participants. You, me, Warren Buffett, giant pension funds, and these super fast trading algorithms.
Okay.
And all of these entities are constantly placing bets, buying and selling based on what they think is going to happen.
It's like a giant collective prediction engine.
Precisely. And this is the hardest thing for beginners to wrap their head around. We are all wired to react to what is happening right now. If I look out the window and it's raining, I grab an umbrella. Simple. But the stock market is looking 3, 6, even 9 months into the future. It's trying to price in what the weather is going to be next season.
He uses the 2009 financial crisis as the perfect example of this. And I remember that time so vividly. It was just bleak.
It was terrifying. I mean, you had banks literally collapsing. Unemployment was skyrocketing. People were losing their homes. If you looked at the real economy on Main Street, it was an absolute disaster. It felt like the end of the world.
It really did. But in March 2009, right in the middle of all that darkness, the stock market hit rock bottom and then started just ripping higher.
And people were furious. I remember the news reports. How can Wall Street be partying while Main Street is suffering? It felt so disconnected from reality.
Yeah, completely.
But the market was doing its job. It was skating to where the puck was going. The collective intelligence of the market looked at the government bailouts. It looked at the Federal Reserve's actions. And it basically said, okay, this is horrible right now, but in 6 months, things will probably stabilize. Companies will start making money again. It was pricing in the recovery long before the recovery was actually visible.
So if you were waiting for the news headlines to be good before you decided to invest,
you completely missed the boat. By the time the newspapers were printing, unemployment is finally dropping. The market was already up 30, 40, maybe 50%. You can't invest by looking in the rearview mirror.
This also explains those moments during, earnings season that are so confusing. A company, let's say a big tech firm, they come out and they announce, we had our best quarter ever, we made billions, and then the stock immediately drops 5%.
Yes.
It feels like a glitch in the system.
It's not a glitch. It's that forward-looking mechanism in action. The traders and algorithms are all saying, that's great, you made a ton of money last quarter. We already knew that. That good news was priced in 3 months ago. What did you say about next quarter?
The guidance.
The guidance. That's the key. If the company says, well, the future looks a little cloudy, the stock gets hammered. The market doesn't pay for past performance. It only pays for future potential.
Wow. That makes sense, but it is frustrating. It means you always have to be thinking 2 steps ahead.
Or you just accept that the market as a whole probably knows more than you do, and you stop trying to outsmart it, which is the whole investor mindset we talked about.
That's a very fair point. Okay, let's zoom in from the big concept to the actual gears of the machine. When I buy a stock, what do I actually own? Crater uses this really helpful analogy about McDonald's to make it tangible.
The pie analogy. It's so simple, but it's perfect. He says to imagine the entire McDonald's corporation, every single restaurant, every deep fryer, every Big Mac recipe, the golden arches themselves, as one single giant apple pie.
Okay, I'm picturing a very, very large and greasy pie.
Now, you take a knife and you slice that pie into about 765 million individual slices.
Those are some paper-thin slices.
They are. But when you go into your brokerage app and you buy 1 share of McDonald's stock, you are buying exactly one of those slices. You aren't just betting on a ticker symbol on a screen. You are a partial owner of the actual business.
So I technically own a tiny fraction of the CEO's desk share.
You do, and you get a say, a tiny one, in how the company is run. And this concept leads directly to a term you hear all the time on financial news: market cap, market capitalization.
Yeah, you always hear Apple just hit a $3 trillion market cap. It sounds huge and impressive, but it's just a simple math equation, isn't it?
It is the simplest math in all of finance.
Yeah.
You just take the price of one slice, the share price, and you multiply it by the total number of slices, the shares outstanding. That number is the total value of the entire pie.
Okay.
And this is why it's a mistake when people say a stock is expensive just because it costs, say, $1,000 per share.
Wait, explain that, because if I have to shell out $1,000, that feels a lot more expensive than a stock that costs $10.
But think about the pie again. If I decide to cut my pie into only 4 huge slices, each individual slice is going to have a very high price. If I take that exact same pie and I cut it into 1,000,000 tiny slivers, each slice will cost just pennies. But the pie is the same size.
Ah, so the share price just tells you how the pie is sliced. The market cap tells you how big the pie actually is.
Exactly. That is a crucial distinction. A $10 stock could represent a much more expensive company than a $100 stock, depending entirely on how many shares exist. Don't get fixated on the share price.
Okay, theory is down. We're buying slices of a future-predicting pie. Now I want to get into the nuts and bolts, the logistics, because this is really where the intimidation factor cranks up to 11 for me. You download an app, you link your bank account, and then suddenly you're staring at a dashboard that looks like the cockpit of a 747.
It is definitely overwhelming, so let's just strip it way down. First, you have the exchange. Think of the NYSE and the NASDAQ.
The actual marketplaces where the buying and selling happens.
Correct. Crater compares them to eBay, which is perfect. eBay doesn't own or sell you those vintage sneakers. They just provide the platform where the person who has the sneakers can meet the person who wants them. The NYSE and NASDAQ are just giant, high-speed digital eBays for stocks.
And there's a little trick to tell which stocks live on which exchange, right? Something about their nicknames.
Generally, yeah. The New York Stock Exchange, the NYSE, that's the old guard, it's been around for centuries. It lists the big blue-chip industrial giants. Ford, Coca-Cola, Walmart, their ticker symbols, the letters you type in to find them, are usually short. 1, 2, or 3 letters. F for Ford, KO for Coke.
And the NASDAQ.
The NASDAQ is the new kid on the block, relatively speaking. It's all electronic. It's the home of tech and innovation. So you've got Apple, Google, Netflix, Amazon, and their tickers are usually 4 letters, AAPL, AMZN, QOGL.
Okay, so I know where the stocks live, but I can't just, walk up to the front door of the NYSE and place an order. I need a middleman. That's the broker.
The broker is your gateway. Back in the 80s, this was some guy named Chad in suspenders who you had to call on a landline phone.
Right.
And he'd charge you $50 or $100 just to place a single trade for you.
That's just highway robbery.
It was. But technology completely democratized the whole thing. Now you have these discount brokers. Crater mentions the big ones like Charles Schwab and Fidelity, which are amazing, rock-solid companies. But he also specifically highlights Robinhood for beginners.
And Robinhood gets a lot of heat in the news sometimes, but he recommends it.
He likes the interface. He thinks it's the most intuitive and easy to understand. But more importantly, Robinhood was the company that forced the entire industry to change. They were the pioneers of zero-commission trading.
So it's free to buy a stock.
It's free. And because they did that, now everybody else had to do it too. That single change removed the biggest barrier to entry for the small investor.
Okay, so I've got my Fidelity or Robinhood app open. I type in AAPL for Apple. I see a big green BUY button. But Crater says, and this part really scared me, that if I just mash that button without understanding one more thing, I could get ripped off instantly.
Yes.
We have to talk about bid versus ask.
Okay, everybody listening, please turn up the volume for this part. This is the single most important technical detail in the whole book for a beginner. When you look up a stock quote, you don't just see one price. You always see 2.
The bid and the ask.
Right. The bid is the highest price that some buyer somewhere in the world is currently screaming, I will pay this much. The ask, which is also called the offer, is the lowest price some seller is screaming, I will sell for this much.
It's basically a standoff.
It's a standoff. And here's the golden rule of trading. You have to burn this into your brain. You sell to the bid, and you buy from the ask.
So if I'm the buyer, I have to pay the higher price. I have to meet the seller's demand.
Correct. You have to cross that gap to make the trade happen. Now, on a huge popular stock like Apple or Microsoft, it doesn't really matter that much. The difference between those two prices, we call it the spread, is usually just 1 penny. So the bid might be $150, and the ask is $150 on one side.
You pay the extra penny? Big deal.
Who cares? Exactly. But not all stocks are Apple. This is where beginners get absolutely slaughtered. Let's say you're looking at a small, obscure company or some weird ETF. We call these illiquid stocks.
Illiquid, meaning not a lot of people are trading it.
Very few buyers and sellers. Think of liquidity like water. Apple is an ocean. You can dive in and out easily. This small stock is a tiny puddle. There's not much activity.
Okay, so I'm trying to buy a stock in the puddle. What does that spread look like?
Well, the bid price, the highest buyer, might be at $10. But the only guy in the world willing to sell it knows he's the only game in town. So his ask price is $12.
Whoa. That's a $2 difference on a $10 stock.
It's a massive 20% gap. Now imagine you're the beginner who doesn't know this and you just hit the market order button.
And a market order is just me telling the broker, get me in now. I don't care about the price.
Get me in at the best available price is the official term. If you do that on this illiquid stock, your app will instantly buy at the ask price, $12. The stock is technically worth around 10, but you just paid 12. You are instantly down nearly 20% the split second the trade executes.
That is an absolute nightmare.
It is. You have to make a 20% profit just to get back to even.
So what's the fix? How do we avoid this puddle trap?
You use a limit order.
This is our shield.
This is your shield. A limit order lets you dictate the terms. You tell your broker, hey, I want to buy this stock, but I am absolutely not willing to pay a penny more than $10.50. You set your limit.
And what if that seller is still sitting there demanding $12?
Then your trade doesn't happen.
Yeah.
You sit and wait. Maybe that seller gets desperate and lowers his price to meet you at $10.50. Maybe a different seller comes along. But you are protected. You will never, ever pay more than the price you authorized.
And Crater says he uses limit orders pretty much all the time, right? Even on the big liquid stocks.
Almost always. Because even with Apple, weird things can happen. Flash crashes happen. Computer algorithms glitch out. If you happen to have a market order sitting out there during one of those 1-second glitches, you could get a terrible price. A limit order just protects you from all the chaos.
Such a simple switch to flip in the settings, but it can save you so much pain. Okay, one last timing thing. The stock market is open from 9:30 a.m. Eastern to 4:00 p.m., but I always see numbers moving around before and after those times.
Yes. The pre-market and after-hours sessions, this is the wild west of trading. Electronic systems allow people to trade outside the normal hours. But Crater's advice for beginners is crystal clear. Don't do it.
Just stay away. If I'm an early bird, why not trade at 7 a.m.?
It goes back to that concept of liquidity again. Most of the big players, the huge mutual funds, the banks, they aren't trading at 7 a.m. It's just a handful of people. So the spreads are huge and the prices can wiggle around violently.
Wiggle sounds kind of cute, but I'm guessing you mean crash and burn.
I mean, volatility, yeah. A stock's price can be all over the place.
Yeah.
I pay $105 for a stock at 8 a.m., and then when the real market opens at 9:30 with all the big players, it opens at $100. You just lost $5 a share because you couldn't wait 90 minutes. Just stick to the regular hours until you really, really know what you're doing.
Okay, that's a deal. Stay in the safe zone. Use limit orders. Don't touch the buttons before my morning coffee. Now let's pivot to the really fun part. What are we actually buying? Because the whole idea of picking individual stocks is terrifying.
Yeah.
I don't have time to read 100-page financial reports. I have no idea if Nike's going to beat Adidas next year.
And you are not alone. Stock picking is incredibly, incredibly difficult. And this brings us right to section 3 in the book, making money with ETFs. This is the perfect solution for the person who wants to be in the market but doesn't want a second job as a financial analyst.
And an ETF it's like a basket of stocks.
That's the perfect way to think of it. It stands for Exchange Traded Fund. It trades just like a regular stock. You can buy one share of it, but inside that one share is a collection of hundreds of other stocks. It's like buying a variety pack of chips instead of going all in on just the salt and vinegar.
And Crater really focuses on the big 3 indices. These are the baskets that let you buy the entire market. Let's run through them.
Okay, first and by far the most important is the S&P 500. The ETF ticker for it is SPY. When you buy one share of SPY, you are buying a tiny piece of the 500 largest publicly traded companies in the United States.
So you get Apple, Microsoft, Amazon, but you also get Johnson & Johnson, Procter & Gamble, ExxonMobil.
Everything, the whole shebang. It's basically a single bet on the future of the American economy. If you believe that, over the long run, American business will continue to grow and innovate, you just buy SPY.
And it's market cap weighted, which connects back to our pie analogy.
Right. The biggest companies make up a bigger percentage of the basket. So a huge move in Apple stock has a big influence on SPY's price. A move in, I don't know, Campbell's Soup Company has a tiny influence.
Okay, got it. Next up, the Dow, the old one.
The Dow Jones Industrial Average. ticker is DIA. This is a bit of a weird historical one. It only tracks 30 companies, but they are the blue chips, the absolute titans of industry. McDonald's, Coca-Cola, Goldman Sachs, these are massive, stable, usually slower growing companies.
And the third one, the tech-heavy one.
That's the NASDAQ 100. The ticker is QQQ. Everybody just calls it the Qs. This is the basket for the tech optimists. It strips out financial companies like banks and loads up on technology, biotech, and communications. So Apple, Netflix, Google. It's more volatile, it wiggles around more, but historically it has produced massive growth.
So the whole strategy here is called indexing. You just buy the basket and you walk away. Why has this become so incredibly popular? I feel like 20 years ago, everyone was trying to find the next hot stock. Now everyone I know just says, I just buy the S&P 500.
Because the data came out, and the data was brutal for the stock pickers. Over the last few decades, researchers looked at the performance of active fund managers, the pros with the fancy degrees. And they found that over any 10 or 20-year period, something like 90% of them failed to beat the simple S&P 500 index.
Wait, hold on. 90% of the professionals failed to beat the lazy option of just buying the basket.
Yes, because of high fees, because of bad timing, because picking stocks is just that hard. So the logic for regular people became, well, if the pros can't even beat the market, why on earth should I try? I'll just be the market. And that's passive investing.
That's actually very humbling, but it's also incredibly liberating. It's like, I don't have to be smarter than Wall Street. I just have to get on the bus with everyone else. And this pairs perfectly with a strategy called cost averaging.
This is the ultimate stress killer. Cost averaging simply means you invest the same dollar amount on the same schedule no matter what the market is doing. Let's say you decide to invest $500 a month. On the first of every month, you buy $500 of SPY, period.
And it doesn't matter if the market is at an all-time high or if it's crashing.
It does not matter. And here is where the math works. It's magic. When the market is high and stocks are expensive, your $500 buys you fewer shares. Maybe you only get 1.5 shares of SPY. But when the market crashes and stocks are cheap, your $500 buys you more shares. Maybe you'd get 3 shares for the same money.
So I automatically buy more when things are on sale.
Exactly. You don't even have to think about it. The math automatically ensures that your average cost per share ends up being lower than the average market price over time. It turns market volatility from being your enemy into being your best friend.
Okay, speaking of volatility, we have to talk about the crashes, the bear markets, because intellectually I get it, buy low. But emotionally, when I log in and see my account is down 30%, I want to vomit. I want to sell everything and hide the cash under my mattress.
That is the natural human fight or flight response kicking in. But Crater really wants us to rewire that part of our brain. He argues very forcefully that if you are in the accumulation phase of your life, meaning you're still working and saving money, a bear market is the single best thing that can possibly happen to you.
You're going to have to convince me on that, because it really feels like losing.
Okay, imagine you go to your favorite clothing store. You walk in, and you see that everything has been marked up by 50%. Are you excited to shop?
No, I'm annoyed. I'm walking right back out.
Now, imagine you walk in the next week, and there are signs everywhere. Everything 50% off. Fire sale.
Okay, now I'm grabbing a cart and I'm loading up.
The stock market is the only store in the world where all the customers run out of the building screaming when things go on sale. When the market crashes, stocks are cheap, their PE ratios are low, their dividend yields are high. If you keep cost averaging through that crash, you are scooping up shares at bargain basement prices.
And when the market eventually recovers...
And historically, it always has. When it recovers, those cheap shares you bought act like rocket fuel for your portfolio's growth. The people who get truly wealthy aren't the ones who sell during a crash. They are the ones who have the courage to buy more during a crash.
Stocks are the only thing people hate to buy when they're on sale. I need to get that tattooed on my hand or something. Okay, so that's the get rich slowly path with ETFs. But what if I need income? What if I want cash flow, like right now? That brings us to Section 4, creating passive income with dividend stocks.
This is a classic strategy for retirees. But Crater makes a great case that young people should be doing this too. It's all about changing your relationship with ownership. He compares it to owning real estate.
Right, the landlord life.
Exactly. Why do people love owning rental properties? Because they get a check in the mail every month. It's passive income. But, as anyone who's ever been a landlord knows, real estate is a massive hassle.
Oh, yeah.
Toilets break at 3 a.m., tenants stop paying rent, roofs leak. It's only passive in name. It's a second job.
It really is.
Dividend stocks, he argues, are true passive income. You buy a share of a stable, profitable company, let's say Johnson & Johnson. They go about their business selling Band-Aids and Tylenol. At the end of every quarter, they take a chunk of their profits and they just mail it to their shareholders. You get a check. You did nothing. You didn't fix the toilet. You didn't manage a factory. You just owned a slice of the pie.
It honestly feels like magic. Here's your cut of the profits for doing absolutely nothing. And to prove that this can work for absolutely normal people, the book tells the incredible story of Ronald Read. I love this story.
It's the ultimate tortoise and the hare fable, but it's real. Ronald Read was a man who lived in Vermont. He worked his whole life as a gas station attendant and as a janitor at a JCPenney.
The janitor.
A janitor. He wore old flannel shirts. He drove a beat-up old car. If you met him on the street, you would assume he was just barely scraping by.
But he had this incredible secret.
He was a compulsive saver and a disciplined dividend investor. He took his small paycheck, lived incredibly frugally, and just bought shares of blue-chip dividend-paying stocks. Then, when the dividend checks came in, he used that money to buy more stock. He just compounded year after year for decades.
And the big reveal.
He passed away in 2014 at the age of 92. And when his will was read, everyone in his town was stunned. He had an $8 million portfolio. He left most of it to the local library and hospital.
$8 million on a janitor's salary. I mean, that just completely demolishes the excuse of, oh, I don't earn enough money to invest.
It proves that time and consistency are infinitely more powerful than a high income. You can make $200,000 a year and spend $201,000 and you'll end up with nothing. Ronald Read proves you can make minimum wage and end up a multimillionaire.
So let's break down the math he was using. He was focused on something called dividend yield.
It's a very simple metric. You just take the total annual dividend the company pays per share and you divide it by the stock's current price. So if the stock costs $100 and it pays you $3 a year in dividends, that's a 3% yield.
Which is usually way better than a savings account.
Way better. But the real secret sauce, the thing that creates fortunes, isn't just the yield today, it's dividend growth. This is the yield on cost concept that Kreider explains using Warren Buffett's most famous investment, Coca-Cola.
Okay, this part of the book absolutely blew my mind. Walk us through the Buffett and Coke math.
So Warren Buffett, through his company Berkshire Hathaway, started buying Coca-Cola stock very aggressively back in 1988. Let's say, for simple math, his average cost per share, adjusted for stock splits, was around $3 or $4.
Okay, so $3 a share.
Right. Back then, the dividend was pretty small. But Coke is a global monster. They sell sugar water to literally billions of people. They slowly raise their prices. They become more efficient. They make more and more profit every year.
And because they make more profit, they can raise the dividend they pay to shareholders.
Every single year for over 60 consecutive years. So today, in the present, Coke pays a dividend of, let's say it's around $1.80 per share per year.
But wait, Buffett only paid about $3 for his original share?
Exactly.
Yeah.
So if you divide today's annual dividend payment by his original purchase price, his yield on cost is something like 50 or 60%.
That is just, it's insane. You're saying that every 2 years or so, he gets his entire original investment back in pure cash.
Yes. And he still owns the stock, which is now worth $60 or $70 a share. That is the unbelievable power of buying a great dividend-growing company and just holding on for 30-plus years. You eventually reach a point where the asset just pays for itself over and over and over again.
So the real goal isn't just to find a high yield today. It's to find a company that has a long history of raising its dividend tomorrow and the next day and the next.
You've got it. You have to beware the yield trap. That's a company paying a 10% dividend today only because its stock price has crashed and it's about to go out of business. You want to focus on the dividend aristocrats.
That's a cool name. What are they?
It's an official S&P list. It's companies in the S&P 500 that have increased their dividend for at least 25 consecutive years. Think McDonald's, 3M, Pepsi, Colgate-Palmolive. These are companies that have survived the dot-com crash, the 2008 crisis, the pandemic, and they kept raising that dividend check.
And if I don't want to try and pick them one by one?
There is, of course, an ETF for that. The ticker is NOBL, as in Noble. It just holds all the aristocrats in one basket for you.
Very handy. Okay, section 5. We've done the safe and steady ETFs. We've done the passive income dividends. Now let's get a little more ambitious. What if I want to pick stocks? What if I think I can be the next Buffett?
Kreider's whole section on this, how to pick stocks like Warren Buffett. And the philosophy is incredibly simple to say, but very hard to actually do. Buy a wonderful business at a fair price and hold it for the next 50 years.
Simple, but not easy. So how do I find a wonderful business?
Well, Crater first suggests a little cheat code. Just copy him.
Wait, is that allowed? Is that legal?
Totally legal, totally public. All large institutional investors who manage over $100 billion, they have to file a form with the SEC every quarter. It's called a 13F. It lists all of their stock holdings. You can literally go online, search for Berkshire Hathaway 13F, and see what Warren Buffett bought last quarter.
So if he buys more Apple, I can buy more Apple.
You can, or there's an even easier cheat code. Just buy the stock ticker, BRKB. That is the ticker for Berkshire Hathaway itself. If you buy that one stock, you literally own a piece of his entire holding company. You are effectively hiring Warren Buffett and his team to manage your money for you.
That feels like the smartest play of all, honestly. But if we do want to do the work ourselves, Prater says there is one specific quality that Buffett values above all else. He calls it a moat, and specifically, pricing power.
This is the ultimate litmus test for a truly great business. Pricing power is the ability to raise your prices consistently without losing your customers to a competitor.
The book uses the example of a gas station versus Apple.
It is the perfect contrast. Think about a generic gas station. You need to fill up your car. You pull up to an intersection. There are two stations on opposite corners. One is selling gas for $3.50 a gallon. The other is selling for $3.60. Which one do you go to?
The $3.50 one. Every single time, it's not even a question.
Of course, because gas is a commodity. You don't care about the brand of the gas. You only care about the price. That gas station has zero pricing power. If they try to raise their price, they go out of business.
But
Apple sells the iPhone. The new one costs, what, $1,000? It's expensive. But if Apple holds an event tomorrow and says the brand new iPhone 18 is now $1,100, do all of their customers suddenly switch to Android?
No. Some might complain, but most of them won't. I'm locked into the ecosystem. I've got the Blue Bubbles, the iCloud, the watch. I'm paying the $1,100.
That is pricing power. That is a deep, wide moat around the business. If a company can charge you more for their product and you still thank them for it, that is a wonderful business. That's what Buffett looks for. It's why he loves Coke, why he loves American Express, why he now loves Apple.
So the question I should be asking when I research a company is this a commodity that people buy based on the lowest price, or is it a brand that people buy based on loyalty and identity?
Precisely. Look for the addiction. Look for the lock-in.
Now, there is a quick reality check on just blindly copying Buffett. The book warns that Buffett is, well, he's an insider.
Yeah, this is important. Don't get too carried away thinking you were Warren Buffett. During the 2008 crisis, Buffett famously bailed out companies like Goldman Sachs. But he didn't just go buy their stock on the open market like you and me. He got special preferred shares with a guaranteed 10% dividend plus warrants to buy more stock cheaply later.
He had a sweetheart deal nobody else could get.
He got the you're Warren Buffett and you're saving the global financial system deal. You can't get that on your Robinhood app. So, by all means, copy his long-term stock picks. But understand that he's playing a slightly different game than the rest of us.
That's a fair warning. Okay, we are entering the final section, and I'll be honest, this feels like the real danger zone. Section 6, value investing and PEs. Because the word value sounds so good. Everybody loves a bargain. I'm the guy who waits for Black Friday to buy a TV.
And that very instinct, the bargain hunter instinct, is what can absolutely destroy your portfolio if you apply it blindly to the stock market. This is the great value trap.
Let's define the terms first. What exactly is the PE ratio?
PE stands for price to earnings. It's the most common way to measure how expensive a stock is relative to how much money the company is actually making. You take the current share price and you divide it by the company's annual earnings per share, which is just their profit.
Can you give me some benchmarks? What's normal?
Historically, the average PE for the entire S&P 500 is somewhere around 15 to 20. So if a stock has a PE of 15, it means you are paying $15 for every $1 of profit the company currently makes.
Okay. And what about fast-growing stocks?
A company like Amazon or Tesla, especially in their high-growth phases, might have a PE of 50, 80, even over 100. The market is willing to pay a huge premium because it expects those earnings to double or triple in the near future.
And on the other end, the cheap stocks.
The distressed companies.
Yeah.
An old industrial company, a bank during a financial crisis. They might trade at a PE of 5 or 8, very low.
So here's the trap. A beginner opens their app. They sort stocks by PE ratio from low to high. They see a company with a PE of 3. They think, oh my God, this is on the clearance rack. It's so cheap compared to Amazon.
And they buy it. And then they watch the stock go down another 50% and then to zero.
Why? What happened?
Because the E In PE, the earnings is based on the past, but the price is based on the future. If a stock is trading at a PE of 3, the collective market is screaming at you, this company is on its deathbed. The market is expecting those earnings to completely disappear.
The Blockbuster versus Netflix example in the book is the all-time greatest case study for this.
It is tragic, and it's perfect. If you go back in time to around 2008, 2009, Blockbuster video stores were still on every corner, but they were clearly struggling. Their stock price had collapsed, and its PE ratio was something like 2 or 3. Mathematically, it looked incredibly cheap.
A total bargain. Look at all the profit they made last year from late fees.
Meanwhile, a tiny little company called Netflix was trading at a PE of maybe 30 or 40. It looked outrageously expensive.
So the classic value investor buys Blockbuster. The growth investor buys Netflix.
And the value investor lost 100% of their money. Blockbuster went bankrupt. Why? Because streaming video was the future. The market knew that Blockbuster's future earnings were going to be 0. So that cheap PE was a mirage. It was a value trap.
And Netflix, obviously.
Netflix grew into its high valuation and then some. Its earnings exploded, which in hindsight made that PE of 40 look like the bargain of the century.
So what's the rule of thumb here for a beginner?
Craddock gives a very hard and fast rule. Do not buy any stock with a PE ratio under 10 unless you are an advanced investor and you know exactly what you are doing.
That feels like a really solid safety rail. If something looks that cheap, there's a very, very good reason. There's a skeleton in the closet.
Exactly. A super low PE usually means the company has a mountain of debt, or their core product is becoming obsolete like Blockbuster's, or they're facing a massive lawsuit. A falling stock price isn't just a sales sign. Often, it's a sign of a death spiral.
A death spiral? That sounds ominous.
It is. Think about it from an employee's perspective. If a company's stock tanks, what happens to all the talented engineers and executives who are paid in stock options?
Their options are worthless. They leave.
They leave. They go work for Google or Apple. So the company starts losing its best talent. Then, to save money, they cut the research and development budget. Then the product gets worse. Then the customers start to leave. Then the stock falls even more. It's a feedback loop of doom.
So the old saying, don't try to catch a falling knife.
And to bring it all the way back, skate to where the earnings are going to be, not where they were last year.
Wow. We have really come full circle, right back to that Gretzky quote. It all connects. The market is just this giant machine that's constantly trying to process the future.
That's what it is.
We have covered a huge amount of ground here. Let's just do a quick recap of the toolkit we've built for everyone listening. We started with the mindset. Don't be intimidated. This machine is for everyone.
Yep. Whether you're a trader looking for that dopamine hit or an investor who just wants to sleep at night.
We covered the logistics. Use a good discount broker. Never, ever use market orders on illiquid stocks. Always use limit orders. And stay out of the pre-market chaos.
Just protect your capital from those simple, unforced errors.
Then we got into strategy. For most of us, the simplest and best path is just buying ETFs. Buy the whole haystack, SPY, QQQQ, and let the market do the hard work for you. Cost average into them and learn to love the crashes because they are just big sales.
The classic, proven get-rich-slowly path.
If you're looking for income, look to the dividend aristocrats, the Ronald Read strategy. Let the magic of compounding yields eventually pay all your bill.
It's like being a landlord without ever having to fix a toilet.
And if you do want to pick individual stocks, look for that pricing power. Look for the moat. And for heaven's sake, avoid those low PE value tracks.
It really is a complete framework. The only thing left is to just start. You can't learn how to swim by reading a book about it. You have to actually get in the water. Go buy one single share of STY, watch how it moves, get comfortable with the feeling.
I think that's the most empowering part of the whole book. You don't need $100,000 to begin. You can start with $50.
Absolutely.
I want to leave our listeners with one final provocative thought to chew on. We've talked a lot about how the market is this efficient machine at pricing in the known future. It knows interest rates might rise. It knows streaming is taking over physical media. So the real life-changing money isn't made on the known trends. It's made by spotting the one thing the market hasn't priced in yet.
The blind spot.
Exactly. So ask yourself, what is a behavior, a technology, or a cultural shift that you see happening in your own daily life, maybe it's with your kids or at your job, that the suits on Wall Street just haven't noticed yet? Because if you can find the thing that will be completely obvious in 5 years but looks almost invisible today, that's where the next opportunity machine is hiding.
That's the question that creates billionaires.
Thank you for watching, Clay. Please like out, share, subscribe, follow up in next topic.
Come back to continue a beginner's guide to the stock market.
It is good to be back, and frankly, I am excited because today is where the rubber really meets the road.
We are diving right back into the deep end with Matthew R. Cratter's book.
Yeah.
If you were with us for the first part of this deep dive, we covered the absolute basics. We laid the foundation. We talked about what a stock actually is, how the market functions as this giant opportunity machine, and the difference between just buying an index fund, the set it and forget it method, and actually trying to pick winners.
Exactly. The first half was the what? It was the landscape. But today we are shifting gears. Significantly, we are moving into the how.
The fun stuff.
The fun stuff, definitely, but also, the dangerous stuff if you don't respect the rules. This section, covering chapter 7 through 13, is entirely focused on active strategies.
Right.
It is about how to actually make money and, crucially, how to avoid losing your shirt using specific tactics like growth investing, trading IPOs, and even a specific strategy for day trading.
And I have to say, reading through this next batch of chapters, I found myself pausing constantly. Because a lot of what Cratter says feels backward.
It does.
It feels completely counterintuitive to how we operate in the rest of our lives.
That is a very common reaction. In fact, if it feels comfortable, you are probably doing it wrong.
Right. I mean, he talks about buying stocks when they are at their most expensive price ever. He talks about why cheap stocks are basically, radioactive traps.
They're traps.
It goes against that bargain hunter instinct we all have. When I go to the grocery store, I want the steak that's on sale. I don't want to pay double what it cost last week. But Cratter says in the market, you should want to pay double.
It does feel wrong, but the stock market is not a grocery store. And that is the central theme we are going to unpack today. The market has its own physics, its own set of rules.
Okay.
And if you try to apply the logic of buy low, sell high, without understanding the context, specifically the context of momentum, you are going to get hurt.
So today, we're talking about that context.
We are. We are going to look at the psychology behind why expensive stocks get more expensive, the mechanics of something called a short squeeze, and the specific rules Cratter uses to find what he calls rocket stocks.
Rocket stocks, I love that term. It implies velocity.
It does.
So let's unpack this. Chapter 7 is all about making money with growth stocks. And immediately, Cratter throws a curveball. He says, and I'm quoting here, ignore the high PE. Now, for everyone listening, let's just quickly establish terms. PE is the price-to-earnings ratio. Traditionally, a high PE means a stock is expensive. Right?
You overvalue, yeah.
Like you're paying a lot of money for every dollar of profit the company makes.
That is the traditional definition, yes.
Yeah.
If you talk to value investors, the disciples of, Benjamin Graham or Warren Buffett, they live and die by the low PE. They want to pay a low price for current earnings.
They're looking for that dollar selling for 50 cents.
Exactly. But Cratter makes a really compelling point here. He says if you refuse to buy stocks with high PE ratios, you are going to miss out on the biggest winners of our generation.
And he lists some heavy hitters to prove his point. Amazon, Microsoft, Home Depot, Netflix. All of them had, at one point, ridiculously high PE ratios.
Precisely. Think about Amazon. This is the classic example. For years, decades, really, people screamed that Amazon was overvalued.
Oh, I remember that. It's a bubble. Doesn't even make money.
Right. It had a sky-high PE ratio. Sometimes it didn't even have earnings. It was losing money to build infrastructure, to build out its whole network. But if you ignored it because the chart said it was expensive or because the PE was 100 or 500...
you missed one of the greatest wealth-generating runs in history.
You missed the whole thing.
So what is the logic there? Why does the market price these things so high if they aren't making enough profit to justify it today?
It's because the market is a forward-looking machine. A high PE ratio isn't necessarily a sign of a bubble. It can be a sign that the market expects massive future growth. Cratter explains that great companies trade at high multiples because investors are pricing in what the company will be in 5 or 10 years, not what it is today. They are paying a premium for those future cash flows.
It's the Wayne Gretzky quote he uses, right?
Yeah.
Skate to where the puck is going to be, not where it has been.
Precisely. And it's such a perfect analogy. If you are looking at a current low PE, let's say a utility company or a dying retail chain, you might be looking at where the puck was.
It's cheap for a reason.
It's cheap because nobody expects it to grow. It has no future. But if you are looking at a high PE, you are often looking at a company that is innovating, expanding, capturing market share. Crater calls these rocket stocks.
Right.
And the thing about rockets is they don't look cheap on the launch pad. They require a lot of fuel to get going.
Okay, so we have to get over our fear of the expensive label. That's hurdle number one. But he takes it a step further. And this is the part that really made me pause. He says you should look to buy stocks that are specifically hitting their 52-week highs.
Or even all-time highs.
Or even all-time highs. The buy high, sell higher philosophy.
Yes.
Yeah.
Mentally, that is so hard. If I see a stock at an all-time high, my brain just screams, it's too late, you missed the boat, it's going to crash.
You're going to be the bag holder.
Exactly, that's the fear.
It is. It's the fear of heights. It is vertigo.
Yeah.
But let's break down the psychology that Crater outlines because it is fascinating and it makes total sense once you hear it.
Okay.
There is a very specific, almost mechanical reason why buying at an all-time high is safer than buying at a 52-week low.
Safer? Really? Buying at the peak is safer than buying at the bottom? That just sounds crazy.
Think about the holders of the stock. Imagine you are in a room with everyone who owns a specific stock. If that stock is at an all-time high, what is the profit status of everyone in that room?
Well, everyone is making money. Even the person who bought it 5 seconds ago is at least even.
Exactly. Every single person who holds that stock is currently sitting on a profit. There are no losers in the trade.
Everyone's happy. Everyone is happy, they feel smart, and when everyone is happy, there is no pressure to sell, there is no overhead supply.
Overhead supply. Break that down for us. What does that mean?
Imagine the opposite scenario. Imagine you bought a stock at $100 and it drops to $80. You are down 20%. How do you feel?
Terrible. I feel stupid. I'm regretting the decision. I'm probably checking it every 5 minutes.
You are miserable. And what are you telling yourself? You're probably praying, just get back to 100. Please just go back to 100 and I'll sell. I just want to break even. I just want my money back.
Yeah, I have been there. The please just let me out prayer. It's a real thing.
Right. That is overhead supply. All those people waiting to sell at break even create a ceiling. As the stock tries to climb back up from 80 to 90 to 100, these people are selling into the rally to get out.
They're dumping their shares.
They're dumping their shares to stop the pain. That selling pressure pushes the price back down. It's like the stock is trying to swim upward with a backpack full of rocks.
That is a really vivid image. The rocks are the regrets of the people who bought higher.
Exactly. But at an all-time high, those people don't exist. You have dropped the backpack, the sky is clear, there is no resistance from bag holders because there are no bag holders.
The path of least resistance is up.
It's up.
That is a really powerful way to visualize it. So at the highs, the only pressure is what? Just people taking profits.
Profit taking, sure. People will always take some profits. But there is another force at play that actually drives the price higher at these levels. And this connects back to the rocket stock concept.
This is the fuel you mentioned.
This is the fuel. It's the short sellers.
Ah, the fuel for the rocket.
Yes. We need to explain the short squeeze because it is central to Crater's strategy here. This is the turbocharger.
Please do. Because I know shorting means betting against a stock, but how does that make the price go up? It seems paradoxical.
So when a trader shorts a stock, they are borrowing shares from their broker and selling them immediately. They're hoping to buy them back later at a lower price to return them.
So they're betting the price will drop.
Right. Now imagine a stock with a high PE ratio, one that value investors hate, and it hits a new all-time high.
Okay. So the stock is going up, not down. The short sellers are wrong.
They are very wrong, and they're losing money. And here is the terrifying part of shorting. If you buy a stock, the worst thing that happens is it goes to zero. You lose what you invested.
100% of your money. That's it.
But if you short a stock, it can theoretically go up to infinity. Your potential loss is infinite.
So the risk is literally unlimited.
It is. So when a stock breaks out to a new high, short sellers get very, very nervous. They start, as Crater puts it, sweating bullets. They are staring at unlimited losses piling up every second.
So they have to get out. They have to stop the bleeding.
And how do you exit a short position? You have to buy the stock back to return it to the broker. So the stock hits a high, the shorts panic, and they start buying to cover their losses. Their buying drives the price up even further, which causes more shorts to panic and buy.
The feedback loop.
It's a feedback loop. It's a stampede.
Wow.
And that stampede is what gives these growth stocks their explosive power. Crater calls short sellers the fuel for the rocket. He actually looks for stocks with high short interest because he knows if that stock breaks out, the explosion will be massive because of all those panicked buyers being forced to participate.
That is diabolical and brilliant. So you're not just betting on the company, you're betting on the panic of other traders.
You're betting on the structure of the trade itself.
But we can't just buy any stock at a high, right? I mean, I can't just look at a list of 52-week highs and throw a dart. Crater gives us a very specific checklist for identifying these potential rockets.
He does. He is very systematic about it. He doesn't just trade on vibes or stories. He needs data. He needs a setup.
Let's run through the metrics he uses. First, he talks about the trend. This seems like the most basic one.
Rule number 1, never fight the trend. He wants to see the stock trading above its 50-day moving average, and he wants that 50-day average to be above the 200-day moving average.
So the short-term trend is higher than the long-term trend. Everything is pointing up.
Correct. It shows momentum is accelerating. If a stock is below its 200-day moving average, it is dead to him.
Just off the list.
Off the list. It doesn't matter how good the story is or if they cured the common cold. If the price is below the 200-day line, it's in a downtrend. You don't buy downtrends, period.
Okay, so we have the trend. Next is market cap. He says, look for companies under $5 billion. Why that size specifically? Why not look for the next Apple among the big giants?
It's about the physics of moving the price. Think of it like inertia. It takes a massive amount of money to double the stock price of a $500 billion company.
Trillions of dollars, right?
I mean, think about Apple or Microsoft. To move that needle requires billions and billions of dollars of new investment flowing in. The fire hose has to be enormous.
But it's a $2 billion company.
Much easier. It takes significantly less buying pressure to send a small company soaring. It's the difference between pushing a car and pushing a freight train. Crater wants to get in when the company is small enough to double or triple, but large enough to be a real business. $5 billion is that sweet spot where institutions, the big mutual funds, are just starting to take notice but haven't fully piled in yet.
So you want to be there before the herd arrives.
You want to front run the herd.
Okay, so small-ish market cap. Then he talks about float. And this is a term I think confuses some people. What is the float and why does he want it under 20%?
The float is the number of shares that are actually available for the public to trade. It excludes shares held by insiders, the CEO, early investor shares that are locked up and can't be sold.
So it's the available supply in the marketplace.
Exactly. And this is just economics 101. If you have a low supply, a small float, and high demand, everyone wants to buy what happens to the price.
It goes through the roof.
Right. Crater explains that stocks with a float under 20%, meaning only 20% of the company is available to trade, are very sensitive to buying pressure. A little bit of buying goes a long way.
And he uses the example of Twitter, right? Back when it IPO'd.
Yes, ticker TWTR. He talks about the run from 45 to 74.
That was a fast move.
It was incredibly fast. And it was because Twitter had a huge demand, but a very small float. It created a scarcity effect. If there aren't many shares to go around, buyers have to bid the price up aggressively to get anyone to sell to them. It forces the price up rapidly.
So we are looking for upward trend, market cap under $5 billion, float under 20%, and then that short interest kicker we mentioned.
Right. Ideally greater than 10% of the float. That's the rocket fuel.
That is the recipe. You find a stock with all those ingredients, and you have the potential for a massive move.
You have an explosive setup.
But, and there's always a, but what goes up must come down. Or at least we need to know when to get off the rocket. Crater is pretty strict about exit strategies. He doesn't just say hold forever.
No, he is. And this is what separates a trader from a gambler. A gambler has no exit plan. A trader has a plan for when they are wrong and when they are right.
Okay, so what are the signals for selling?
He gives a few. One is purely technical. If the stock closes below its 50-day or 200-day moving average, the trend is breaking. The party's over.
The rocket has run out of fuel.
Exactly. Get out. Don't ask questions. Don't hope it comes back. Just get out.
Simple enough. But he also gives a psychological signal, which I thought was hilarious, but also very, very true.
The losing sleep indicator.
Yes. When you are so excited, you are losing sleep. Tell me about that.
It sounds funny, but it is a real danger sign. If you are so euphoric about your profits that you can't sleep, or you are fantasizing about buying a boat, or telling everyone at the gym how smart you are,
You're checking your account every 2 minutes to see how much more money you made.
your emotions have taken over. And that is usually the top. That is when the market is about to humble you. Greed has set in, and that's when you make mistakes.
He also mentions risk management here, which is maybe the most important part, the 1% rule.
This is critical. This is how you stay in business. Never risk more than 1% of your trading account on a single trade.
Now, let's be clear. That doesn't mean you only invest 1% of your cash.
No. That's a very important distinction. It means your risk is 1%.
Right. Can you give an example of how that works?
Sure. Say you have a $100,000 account. 1% is $1,000. That's your maximum acceptable loss.
Okay.
You can buy $20,000 worth of stock, but you must set a stop-loss order so that if the trade goes against you, you automatically exit with a loss of only $1,000.
So it protects you from a catastrophe.
This is how you survive the learning curve. You can be wrong 10 times in a row and still have 90% of your capital left to trade another day.
That is a crucial distinction. It's not, I only invest $1,000. It's, I only lose $1,000 if I'm wrong. It keeps you in the game.
Exactly. Survival is the name of the game.
All right, let's move it to Chapter 8. IPOs. Initial public offerings. This is often sold as the golden ticket. Get in on the ground floor. Be the next early investor. But Gratter, he is a bit skeptical, isn't he?
He calls it the IPO trap, and he frames it in a way that really exposes the power dynamics of Wall Street. He talks about smart money versus dumb money.
And spoiler alert, we, the retail investors, are usually the dumb money in this scenario.
Sadly, yes. I mean, think about it. When a company goes public, who is selling the stock?
The insiders.
It's the insiders, the founders, the venture capitalists. These are the people who know the company best. They know where all the bodies are buried. They know the real sales figures.
And they are choosing to sell now.
They are choosing this moment to cash out. So when you buy an IPO on the first day, you are basically buying from someone who thinks now is a great time to take their money off the table.
You are providing their liquidity. You are their exit strategy.
Precisely. And Kratter points out a structural change in the market that makes this even worse today than it was 20 years ago.
What's that?
Companies are staying private much, much longer.
The Amazon versus Uber comparison really highlighted this for me. That was a perfect example.
Right. Amazon went public in 1997. It was a small company. It was worth, what, $400 million? If you bought the IPO, you rode the growth from a small company to a $1 trillion company. The public got to participate in that growth.
But Uber
stayed private for a decade. By the time it IPO'd, it was already worth $80 billion.
Wow.
All the massive growth, the 100x returns, all of that had already been captured by the private equity guys and the venture capitalists. The public was just offered the leftovers at the top.
That is depressing. So is the advice just never buy an IPO?
Not necessarily, but you have to know which game you are playing. He breaks it down into two approaches. Are you an investor or are you a trader?
Okay, break that down for us. What's the investor approach?
If you are an investor, you're looking for the next Coke or Home Depot to hold for 30 years. You have to be willing to suffer. Even Coke dropped 50% in its first year after going public.
50%.
50%. Facebook dropped 50% right after its IPO. The question is, can you hold through that kind of pain? Most people can't. They panic and sell at the bottom.
And the trader approach?
The trader approach is to play the volatility. IPOs often have that small float we talked about. This makes them move fast. So Kratter suggests waiting. Don't buy on the first day.
Why not?
It is pure gambling. It's just chaos. Wait for the stock to settle into a range, creating a trading box or a base. Let it prove itself. Then you buy the breakout from that range.
He mentions GoPro as an example of this, right? Had that big base and then exploded higher.
Yes, GoPro had a massive run. But notice he treated it as a trade, not a marriage. You buy the breakout, you ride the momentum, and you get out before it crashes back to earth.
Which it did.
Which it absolutely did. Because remember, many IPOs eventually fail or trade below their offering price.
He also warns about the lockup period.
Mm-hmm.
This is a specific date, usually 6 months after the IPO. This sounds really important.
This is a critical date to mark on your calendar if you own an IPO. For the first 6 months, the insiders are legally forbidden from selling their shares. But the day that lockup expires,
the floodgates open.
The floodgates open. Suddenly, millions of shares can hit the market as employees and early investors cash out to buy houses and cars and whatever else.
Which increases supply.
Dramatically. And it usually crushes the price. So if you are holding an IPO, you need to know when that lockup expiration is coming so you don't get caught in the avalanche.
Okay, so IPOs are high risk, high reward, and require a ton of timing and patience.
Exactly.
But what about when the market isn't rocketing? What about when it's just boring? Chapter 9 is titled, How to Profit from a Stock That Is Going Nowhere.
This is one of my favorite chapters because it introduces a strategy that professionals use all the time, but beginners are often scared of. It's called covered calls.
The word options usually scares people off. It sounds like gambling or, complex calculus.
It can be gambling if you're just buying calls and puts blindly. But the way Crater describes it here, it's not gambling. It's more like being a landlord.
A landlord for your stocks. I like that. Okay, walk me through the going nowhere scenario.
Okay, so imagine you own a stock. Let's say it's trading at $47. It's a good company, maybe a big blue chip, but it's just chopping sideways. It goes to 49, drops to 46, back to 47. It's boring.
It's dead money. You're not making anything.
Right. But you can rent out your shares to generate income. This is the covered call. Here's the mechanic. You own 100 shares. You then sell a call option to someone else.
Okay.
Let's say you sell a call with a strike price of $48 that expires in a month.
Okay, so I am selling someone the right but not the obligation to buy my stock from me at $48.
Exactly. You are entering a contract. You say, I will let you buy my stock for $48 anytime in the next month. And for that privilege, the buyer pays you cash right now. That is called the premium.
So I get that cash immediately into my account.
Immediately. It is yours to keep no matter what happens next. That is the rent you collected.
Now, what are the possible outcomes here?
Okay, scenario A. The stock stays boring. It ends the month at $47.50. The option expires worthless.
Why?
Because nobody wants to use their right to buy your stock for $48 when they can just buy it for $47.50 on the open market.
So I keep my stock and I keep the cash premium.
Win-win. You made money on a boring stock. You manufactured your own dividend. Now, scenario B, the stock rallies to $50.
Okay, now the guy I sold the option to wants my stock. He's happy.
Correct. He exercises the option. You must sell him your shares for $48, as you agreed.
So I miss out on the profit from 48 to 50.
Yes, that's the trade-off. Your upside is capped. You sell at 48, plus you keep the premium you collected. So you still made a profit, you sold for more than you bought it for, but you missed the rocket move.
That's the catch. If the stock goes to the moon, I'm left waving goodbye from the launch pad.
Exactly. That is why Crater says this is a strategy for boring markets.
Yeah.
If you think a stock is about to explode, do not sell covered calls. But if you think it's going to drift, it is a fantastic way to generate income and lower your risk.
It sounds like a great way to smooth out returns. It's a defensive strategy.
It is. It lowers your cost basis on your shares over time. It's consistent. It's the tortoise strategy in the race.
All right, let's flip from boring to adrenaline junkie. Chapter 10, a day trading strategy that actually works. Now, Crater admits most day traders fail. It's a brutal game.
Oh, it is. The statistics are awful.
But he offers one specific setup based on the lumbering giant theory. I love this visual.
It is the perfect analogy for market structure. He compares retail traders, you and me, to agile speedboats. We are small. We can turn on a dime. We can enter and exit positions in seconds without moving the price.
And the institutions, the mutual funds, the hedge funds.
They are the oil tankers. They are the lumbering giants. If a massive mutual fund wants to buy into a stock, they can't just click buy. Their order is so huge, it would spike the price instantly and ruin their own entry.
Right.
So they have to buy slowly over hours or days or even weeks. They leave a wake.
And the strategy is to surf that wake.
Exactly. We want to spot when a giant is entering the water and ride alongside them for a little while.
So what is the specific setup? How do we spot the giant?
Crater focuses on earnings gaps. This happens when a company reports earnings that are surprisingly good. The next morning, the stock gaps up, meaning it opens significantly higher than it closed the day before.
Okay, so the stock opens high. The temptation for a beginner is to jump in immediately at the opening bell, right? Fear of missing out. FOMO.
And that is a huge mistake. The first few minutes are chaos. It's amateur hour. Emotions are flying. The spreads between buy and sell prices are wide. Crater says, wait.
How long do we wait?
15 minutes. Watch the first 15 minutes of trading, let the dust settle, and you mark the high price and the low price of that 15-minute window.
Okay, so I've got my range for the day so far.
Now, you set a trap. You place a limit order to buy if and only if the price breaks above that 15-minute high.
Why above? Why not try to buy it if it dips?
Because if it breaks the high, it signals that the lumbering giant is buying. The initial pop wasn't just a fluke. The institutions are stepping in to accumulate shares. They are committed. You want to buy as the price is pushing new highs for the day, confirming the strength.
And then, once you're in?
You ride it. The giant's buying pressure should push the stock up throughout the day, but, and this is critical, you exit before the market closes. This is a day trade.
You do not hold overnight.
No. Overnight involves too much unknown risk. A CEO could resign, a factory could burn down. You go home flat. No overnight risk.
And what if it goes the other way? What if it breaks below the 15-minute low?
Then you stay out. Or if you are already in, that is your stop loss. If it breaks the low of the opening range, the trade has failed, the giant isn't buying, maybe they're selling into the strength, get out immediately.
It's surprisingly simple. Wait 15 minutes, buy the breakout of the highs, stop out at the low, go home flat.
Simple, but not easy. It requires an incredible amount of discipline. You have to wait that 15 minutes while watching the stock jump around. That takes patience. Resisting the urge to jump in is the hardest part.
Speaking of discipline, Chapter 11 is the scared straight chapter. 5 huge mistakes that beginners make. These are the 5 commandments.
These are written in blood, mostly the blood of trading accounts that went to zero.
Commandment number 1, don't buy 52-week lows. We touched on this with the rocket stocks, but he calls it the cockroach theory here.
Yes. There is never just one cockroach. If you see one cockroach in your kitchen, you know there are hundreds more hiding in the walls.
Gross, but a very effective analogy.
It is. If a company releases bad news, like General Electric did for a while, one bad thing after another, it is rarely an isolated incident. Bad news clusters. Management might be hiding more problems. The culture might be rotting.
So trying to catch a falling knife is usually just catching the first of many cockroaches that are about to come out.
Exactly. When a stock is crashing, it is crashing for a reason. The market knows something. Don't be the hero thinking you are smarter than the entire market.
Commandment number 2, don't trade penny stocks.
The Wolf of Wall Street territory. Crater is very, very firm on this. If a stock trades under $5, avoid it.
But they're so cheap. If I have $500, I can buy thousands of shares. It feels powerful.
That is the siren song. That's the trap. But you have to ask, why are they cheap? Usually because they are garbage companies on the verge of bankruptcy. They are illiquid. They are prone to fraud and manipulation.
And the volatility is insane.
It works against you. If a $1 stock moves 10 cents, that is a 10% swing. You can lose your account balance in the blink of an eye.
Plus, he mentions the bid-ask spread can kill you. You might buy at $1, but the best sell price is only 80 cents instantly. You're down 20% the second you enter the trade.
Correct. It is a rigged game for amateurs. Stay away.
Commandment number 3, don't short stocks.
Now, this might sound contradictory because we just talked about how short squeezes are rocket fuel, but Crater's advice for beginners is do not short.
Because of the infinite risk we talked about earlier.
Yes. When you buy a stock, the worst case is it goes to zero. You lose what you put in. When you short a stock, you lose money if it goes up. And since a stock can go up infinitely,
You can lose more than you have. You can go into debt.
he tells the horror story of Joe Campbell. It's a famous cautionary tale in the trading world. Joe Campbell shorted a penny stock, so he was breaking 2 rules at once.
Oh, boy.
He had a $37,000 account. He went to a meeting or went to bed, I forget the exact detail, but he stepped away from his screen for a few hours. He came back, and the stock had exploded on some news. It gapped up hundreds of percent. Not only was his $37,000 gone, but he owed the broker $106,000.
Wow.
He was in debt over 6 figures overnight. He had to start a GoFundMe just to survive.
That is the stuff of nightmares.
It is asymmetric risk. The upside is capped at 100%. The downside is infinite. It's a terrible bet for a beginner.
Plus, he mentions you have to pay the dividends if you are short. I did not know that.
Yes, another hidden cost. You are liable for the dividend payments that the stock you borrowed would have paid. It's just another cost that eats at you while you wait.
Okay, commandment 4, don't trade on margin.
This ties right into the Joe Campbell story. Margin is borrowing money from your broker to trade. Leverage.
It cuts both ways.
It cuts both ways. It amplifies your wins, but it also amplifies your losses. And if you lose too much, you get the dreaded margin call. The broker forcibly sells your positions to cover their loan.
Usually at the worst possible time, right at the bottom.
At the exact worst time. They don't care about your trade. They care about getting their money back.
And finally, commandment 5, don't trade other people's ideas.
This is a big one for the social media age. Hot tips. Your neighbor, your Uber driver, or some guy on Twitter shouting about a stock that's going to the moon.
Or even the analysts on TV. They seem so professional.
Especially them. Crater calls analysts lagging indicators. They upgrade a stock after it has already risen and downgrade it after it has already crashed. If you are following them, you are always late to the party.
And the other problem is conviction, right? If I buy a stock because you told me to, I don't really know why I own it.
Exactly. So when the stock drops 10%, what do? You panic. You don't know if it's a buying opportunity or a disaster. You have no conviction because you didn't do the work.
If you didn't do the research, you won't know when to hold or when to fold.
You'll always sell at the worst time.
So do your own homework.
Always. Every single time.
We are heading into the home stretch here. Chapter 12 and 13 are insider secrets and the conclusion. Crater drops some rapid-fire wisdom here. One thing that stood out to me was the idea of reaction over news.
This is a golden rule of trading. It connects back to our day trading strategy. The news itself matters less than how the market reacts to the news.
Give me an example of that.
Let's say a company reports record profits. Amazing news, right? The headlines are great. But the stock price falls 5% that day.
That sounds confusing. Why would that happen?
It's bearish. It's a huge warning sign. It means the good news was already priced in and the market is disappointed it wasn't even better. Or it means smart money is using the cover of good news to sell their large positions to the unsuspecting public.
So if a stock falls on good news,
Get out.
and the reverse, what if there's bad news?
If a stock reports bad news, say they're getting sued, and the stock rallies anyway, that is incredibly bullish. It means the market doesn't care about the bad news. The demand is so strong it completely overrides the negative sentiment.
Listen to the market, not the news anchor.
Precisely. The price tells you the truth.
He also mentioned seasonality. Sell in May and go away. Is that real?
It's an old adage, but the data generally backs it up. September is historically the worst month for stocks. The period from November to April is usually the strongest. It doesn't mean you sell everything in May and go to the beach, but maybe you trade smaller. You respect the summer doldrums when volume is light.
And finally, he talks about industry leaders. Buy the king.
If you are going to invest for the long term, buy the company with the highest sales in its industry. Home Depot, not Lowe's. McDonald's, not Burger King. Visa, not Discover.
Right.
They have the moat. Being number one offers a level of protection, pricing power, and compounding that number 2 and 3 just don't have.
It's hard to kill the king.
It is. They have the resources to crush competition.
So we have covered a lot today. From rocket stocks to boring covered calls, from the adrenaline of day trading to the horror of margin calls and penny stocks, Crater wraps up the book with a reality check.
He does. He says, and this is a great quote, trading is simple, but not easy.
That's the paradox, isn't it? The rules we just discussed, they aren't that complicated. Buy above the 50-day line. A fifth grader could understand that concept.
But sticking to it, when your own money is on the line, when fear and greed are screaming at you, that is the hard part. That is what separates the winners from the losers.
And he says that's why 90% of traders quit within 6 months.
They lack the discipline. Or they blow up their account because they ignored one of those 5 commandments. They bet big on a hunch, or they shorted a rocket stock, or they bought a falling knife.
Crater ends with a bit of hope, though. He says it is a learnable skill.
It is. It's not magic. It's not gambling if you follow the rules. It is a profession. And like any profession, you have to survive the internship. You have to survive the learning curve without going broke.
And that really brings us back to the core message of these chapters, doesn't it? Whether you are actively trading or passively investing, you have to respect the market. You have to understand the psychology, both your own and the mob's.
And you have to check your ego at the door. As the old Wall Street saying goes, and Crater quotes this at the end, bulls make money, bears make money, but pigs get slaughtered.
Greed is the enemy.
Greed will kill you every single time.
Well, I think that is a perfect place to leave it. We have unpacked the how of active trading, from the explosive to the defensive. There is so much here to digest. I feel like I need to go look at some charts right now.
Just remember the 15-minute rule, no jumping in at the bell.
I will. Thank you for watching, and please like up, share, subscribe, follow up in the next video.